Hey guys, how are you? Adam Markley here, co-founder of Dealmaker Wealth Society. I got Carl Allen with me and John McIlroy, lead coach for us in Dealmaker Academy, which is our group coaching program. John, welcome. Glad to have you here.
How are you? Adam Markley.
Fantastic to be here. Really looking forward to it.
Hey, John. Happy Friday.
Yes.
You guys ready for the weekend?
Oh yeah.
Yeah, I think I'll probably be sitting at home this weekend, Adam. I don't know, kind of quiet weekend, just like the last four. So
Yeah, I'm going to be hanging in this weekend, I think. Might spend a bit more time in my garden. It's been a wild week because even though we're in quarantine, we're doubling down in lots and lots of different areas. There's so much freaking opportunity out there in all things. So I'm working harder now than I was before lockdown. So I don't think I've seen my family all week. So I'm probably gonna hang in the garden this weekend and chill out.
Here's what people are doing in my part of the world for excitement. There's a Krispy Kreme donut shop that's got drive-through open. The lineup is 2 hours long. When they interviewed the people in it, they said, "Hey, it's better than sitting at home. I got the radio going. I'm outside. They're happy to sit in line for 2 hours." So that's how bad things are getting.
So we need to buy a Krispy Kreme donut store. That would be great right now.
I feel like that immediately moved to the priority list. It was wild. I was coming back, I think from the grocery store or something last weekend maybe, and all the fast food places. I mean, they had lines that were, dozens and dozens of cars deep. I guess people were just looking for something other than home cooking.
Exactly. I don't know. Just get outside. You can't
do something.
Without getting hassled. But if you're line up for the donut shop, you're okay.
Yeah, most of the fast food stuff's closed down in the UK. So drive-through Starbucks, drive-through McDonald's, they're not open. So
wow. So you really are stuck with home cooking, huh, Carl?
Yeah, a lot of the independent stuff is still open. Like a lot of local restaurants are doing takeout, and those guys are killing it right now. In fact, one of my buddies owns an Italian restaurant. After the lockdown, he's not going to reopen as a dining restaurant. He's making 4 times more money because he's pivoted to doing delivery. So that's going to be his new business model. It's insane that the way behaviors are changing through this situation, and the way I'm seeing a lot of businesses pivoting and not only surviving but thriving. They're changing their business models and they're making a ton of additional cash flow. They're never going to go back.
Well, hey guys, we're just getting started here, letting some people come onto the live. Looks like we're close to 40 already, which is great. Let's keep stacking in. As we're going through this deal review, drop your questions in the chat, and we'll be happy to answer them at the end and as we go. So looking forward to this. This is something super special. This is something we've never done, 1 live, 2 publicly, right? So Carl, John, and I regularly review deals within Dealmaker Academy, which is our group coaching program. We call it red light, green lights. And what that means is we are evaluating a deal on a fly. We're showing you how we think, how we conceptualize deals very quickly, right? And the reason we do that is because we want people to understand and know that sometimes when you're sitting across from a seller, you've got to be able to respond and think quickly. You got to ask the right questions, think about what's happening with the market, the industry, and what's going on. And so we're super excited to be able to show you guys how we think about this, how we do with it, and we're just excited to get this out there in front of you. John is our lead coach. John's got a pretty tremendous set of bona fides in his own right. He's been not just an absolute brilliant instructor in many ways, in many decades of his life. He's not a day over 25 though. So we're really glad to have him, and he's gonna set this up. He's gonna lay out the company. It's a company Carl and I have not seen. We know nothing about this deal. This will be cold to us. So we're gonna analyze it right alongside with you guys. We've not seen anything about this. We're excited for it. So John, we're looking forward to this. I'm gonna kick it over to you here real quick, unless anyone else has anything before we get started.
Just to check, because obviously I've never seen the deal before, is if this is a student's deal that's been submitted that we're going to basically analyze. If the student is watching this live, it's going to be the most valuable hour of their life that they've ever invested. You've got 75 years worth of deal making chops on this call, probably close to 500 deals between us reviewing your deal. This is what we do every week in the Dealmaker Academy. We do this with our own deals. So we're not just teaching this stuff for our Academy members. This is the process we go through on all of the deals that Adam, I, and John are doing inside of our Prox private equity group as well. So, and I love looking at these completely cold. So I might love this deal, I might hate it, I might golden buzzer it. I've done 2 golden buzzer deals in the past maybe 18 months. And if you're not, if you don't watch The X Factor or America's Got Talent, when an act comes on stage and they literally blow the audience away, one of the panelists is allowed to golden buzzer them and they go straight to the final. So I've done that twice. I've had 2 golden buzzer deals, and I think both of the, at least the first one was closed by the student that submitted it following our advice. I'm not sure about the second one. And then we almost had a golden buzzer deal yesterday inside.
Yeah, yesterday was really close. I mean, fabulous company.
Century.
I mean, company doing 5.5 million of revenue and putting 2 million on the bottom line. So 40% margins, wonderful little company. Again, almost a golden buzzer. I'd say it was just a hair away right there, Carl.
It was, yeah. So I'm excited to see this deal, whatever it is. I know nothing about this deal whatsoever.
All right, so Doug's asked, what's a golden buzzer? Well, Doug, a golden buzzer is a company that's effectively a unicorn. It sets up perfectly for an LBO. It's got strong cash flows. Would be a no-brainer deal in just about any way. Lots of growth, lots of opportunity.
And easy to close as well.
Yeah, something that we think it's a seller that's well positioned, extremely motivated. It's a company that's got really strong fundamentals financially, meaning strong cash flows, strong balance sheet, assets to leverage. It ticks literally all the boxes. So we're looking forward to hopefully finding more of those. But a unicorn is indeed hard to find. So without further ado, John, I'm going to turn it over to you. So take it away. You're going to share your screen so everyone can see the notes and the details of this deal. And again, as you guys have questions, just drop them in. We'll try to answer them as we go and as we analyze the deal. So John, take it away.
Okay, thank you for that, Adam. I do want to stress that I didn't really try to find a golden buzzer deal. I thought it'd be more valuable just to take a look at a typical deal that comes across our desk, that's submitted, that's got pluses and got minuses. So that was really the framework that I used to choose this deal. Just to set it up for everybody, on the left-hand side of their screen, they're going to see the notes that I put together. And those notes will be things that are submitted sometimes by the people who are trying to do the deal. Sometimes it comes from the information memorandum. Sometimes I'll go to the website, check around a little bit there, just to kind of give us an overview of, some of the intangibles associated with the deal. And then over here on the right-hand side are the numbers. And so the way, maybe I'll give you just a really kind of brief overview of the numbers before I walk you through this. What I like to do at the bottom here is really reproduce the financial statements. So you'll see the balance sheet above. I do this for 2 reasons. Number one, for, if Adam and Carl want a quick look, they don't have to go back and reference the financial statements that are right here. But I'm also going to use these numbers in a little model that we put together to help us value the company and determine how much financing we can put in place and determine what the coverage ratio is vis-a-vis the amount of cash flow the company's generating and the obligations on the debt side and the seller note side of the business. So I'll reproduce the balance sheet. Then I'll reproduce the 3 years of the operating profit and loss statement. I'll get into why we've got some red numbers down here in a minute. And we feed those numbers into our model. And once I get into the numbers, I'll explain a little bit more about the model. But I want to get over here to the notes, just because it's a good way to put everything into context. This business, they're a manufacturer of high quality, bespoke architectural metalwork to retail, commercial, and the construction sector. Now, just to give you the proper sort of framework here, they design it, they build it, they install it. So right soup to nuts on high quality architectural metalwork. So some of the projects that they would work on, typical projects might include staircases, handrails, glass racks, bars, balustrades, canopies. This is a US deal. It's located in the US Southeast. The company was launched in 2002. Now, one thing I should note here, these are confidential deals. So I make sure, double and triple check, that there's nothing in the presentation that would allow anybody to, hone in on exactly what company it is. That's really important. The asking price on this deal, not specified. It's been listed for about 7 months. It is an S Corp. There are 4 owners, 2 teams of husband and wife. Each of the 4 own 25%, and all 4 are active in the business. Now, the very first thing we look for in that kind of a situation is there a shareholder agreement? It's not an LLC, so there's not going to be an operating agreement. And whenever you have 4 people, especially 2 competing husband and wife teams, which we've come across in the past, it's really important to figure out how decisions are made, right? So we would check for a shareholder agreement. It was not disclosed in the information that was provided to us in this deal, but that would be certainly one question on our list. The motivation for sale, all 4 want to retire. I mean, they're willing to stay up to 2 years if absolutely needed during a handover period, but they have identified second-tier management that would be ideal. Of course, nothing has been arranged, but they are perfect candidates to step in and take over from the current owners. Now, the business is carried out in 2 locations, and the location is important in this deal. Both of them are leased from related entities, i.e. one of the shareholders. And I think there's actually different shareholders that own the different locations. I think it's 1 family each. So the relocation of the premise is likely going to be something that's going to be required sometime in the first 2 to 3 years after sales, but there was a certain amount of vagueness associated with that. It wasn't anything really etched in stone. Typical clients for a deal like this would be airports, TV stations, retail stores, office buildings. About 40% of their business is in the retail side. 60% just comes from general commercial. Their trade area is the US and Canada, primarily in the US, but they do a little bit of work in Canada. They've had 162 clients over the last 5 years. 76 of them were active during the trailing 12 months. That's a fairly good ratio, at least in my opinion. They have $3 million in their order book going forward, and they're expected to generate around $3.5 million in revenue in 2020. An obvious question was, did that estimate come out in December of 2019, or is that a current estimate, April 2020, with the world that we're living in right now, spring of 2020? So that obviously would be a question that would also go on our list. Most of their work they get comes from winning bids on RFPs that were issued. So they're very good at scanning the market for RFPs, requests for proposals. So when you get a request for proposal, it's an official document. You have to tender on that. You have to put in your bid. Your bid is legally binding. You've made an obligation to be able to deliver the specific amount of work for a specific price. And this is really hard for me to believe. They claim a tender success rate of 75%, which means that 75% of the jobs they bid on, they actually get. How do they compete? They compete on compressed lead times. They claim to really be able to put these jobs together in a really, time-sensitive fashion. So if you're in a hurry, these are the people to deal with. Highly skilled and experienced team, very strong customer service. The sellers are eager to retire, but are not distressed. And I think Carl and Adam will probably expand on the concept of distressed a little bit in this call. Let me just say, in terms of a preliminary remarks, we like to buy companies where the sellers are somewhat distressed, but not the business being distressed. And by distressed means they're highly motivated to sell for one reason or another. It could be a family issue, could be a health issue, could be any number of issues. So when we see a distressed seller of a non-distressed business, that is one of the check boxes that we have on our list. And when we talk about golden buzzer deals, the golden buzzer deals are the ones that check all the check marks on the list, which is one of the things that we took a look at yesterday. So typically at this point in time, I'd throw it over to Adam and Carl, get their general comments before we sort of dive into the numbers.
Okay, Adam, do you want to go first with some quick thoughts?
We can't hear you, Adam. You're muted.
Just a couple of things I picked up on right off the bat is looks like there's GM in place. Which is always a big positive. We say distressed sellers. I would want to dive into that. We can define distressed sellers a little bit, but the biggest thing I would want to talk about is there's really 4 owners and they each own 25%. So 2 two teams of a husband and wife. So it's unlikely with 4 people that they're all equally willing to retire at the exact same time. So to me, that's one of the first things I'd really want to understand is the why. Why are they all looking to retire at the same time? Again, that's atypical to have that many people, even if they're couples, all looking to stop working at the same time, even with some kind of 24-month, as you say in the notes, John, retirement period. So that's one of the things. I did some quick math. It says they've had 76 active clients in the last 12 months, and I just used the 2019 revenues. That's an average job size of 44K per client.
Not a lot, is it? It's quite low.
It's quite low, but for someone doing staircases, handrails, glass racks, bars, and canopies and things like that, those aren't going to be $1 million jobs. I actually like that because that means they're competing well. If you're doing an RFP process for 50K jobs, that's you're doing a lot of volume of acquisition of jobs there. So
yeah. Here's the massive growth opportunity with this business. Why aren't they talking to the rest of the other 162 clients in real time? So I've just done some mental math. I think there's 86 clients that they've had over the last 5 years that they're not talking to. They're not remarketing to those customers. And I'm guessing, having owned businesses in the construction sector previously, their customer is probably not the airport, the TV station, the retail store, the office building. Their customer is going to be the management contractor that's got the job from the architect or whoever to basically project manage the whole build out or the retrofit project, whatever it is. And then their job's to go and broker all the different trades and all the materials and all the different things. So if they've had 162 clients in 5 years, but there's only 76 of them active, they could double their business in 12 months by actively marketing and targeting all those other customers that they haven't seen. Because what's really interesting, when you look at the numbers, this is what I call a steady as she goes business. Just look at the numbers. The revenues are basically flat, went from 3.1 to 3.5, back down to 3.3. So it looks like a kind of one of those typical sleepy businesses. It's just ticking along. They're not aggressive in terms of their marketing or their growth. They probably get most of their business from referrals and repeat customers. But I don't think they're as aggressive as they can be in really looking to scale this business. And the margins are always around the kind of 20% mark, aren't they? 600, yeah. 660, 637. So what the other thing I'll mention as well.
I know we haven't gotten into the numbers really yet. We'll let John walk through those in a second, but I think you're absolutely right, Carl. With 162 clients over the last 5 years, one of the biggest things I'd look at is those clients represent a subset of other markets and other industries and things like that. You can access the list of those kinds of clients and be marketing your services to them directly. Whether you're picking up the phone, you've got salespeople actively reaching out, traveling, what have you. I think you've got enough almost like lookalike type opportunities where if they're doing a ton of stuff in airports, TV station, retail stores, well, there's a lot of airports, big, small, and in between. Same goes for TV stations and office buildings and things like that. How are you really pushing out your footprint? Because of these size jobs, my guess is they're building things and then delivering things, and you can deliver things in a pretty wide geographic range, especially here in the U.S. With our highway system and things like that. So, I think, John, let's go over the numbers. Let's talk about the company from a financial perspective, and we'll get some more thoughts in after that.
Can I just make one other really critical point before we do that? So when we talk about deals, when we talk about the LBO model, and you guys have seen it before, we talk a lot about the deal making triad. The 3 points of the perfect deal is, number one, the deal's highly related to you and the type of business you want to buy. Number 2 is you've got a highly motivated seller of a strong business. And number 3, it's got financial DNA, which will allow it to be structured using an LBO. What I'm seeing in the marketplace, especially right now, is a lot more focus on point number 2, that kind of distressed seller. And what's interesting is normally when you can laser in, if you've got one seller in the business and you can really laser in on that seller psychology and that seller mindset and really understand, why they want to sell, what they're looking for, what the reasons are, then you can basically build a deal around that. And I always say these types of deals, they're 90% psychology and 10% numbers, and this deal's no different. One of the challenges you might have with this deal is you've got 4 different mindsets at play. You've got 4 different owners, 4 different sets of psychology. And the other issue as well is, I'm guessing with 4 shareholders, this business is going to have a shareholders agreement. And inside of that shareholders agreement, it's a legal document that you have in a business when there's more than one of you that own it. So Prox, for example, which Adam and I own, we still have an operating agreement, even though we're best friends and there's only 2 of us. And the operating agreement sets out kind of the rules on how the business is run. What happens if somebody wants to sell? What happens if they want to hire somebody over a certain amount of money? All those different things. So in that shareholders agreement, there will be things called drag and tag rights. And what that means is, and I'm guessing, because I've never seen the business before, I've certainly not seen an operating agreement, even if there is one. But it might be that 3 out of those 4 shareholders, so a 75% block of votes is required to sell the business. So you'd need in this deal to really drill into each of the 4 owners and really zero in on the ones that have got that higher degree of motivation.
Okay, and before we jump over to the numbers, I do want to make one very small point here as well, and it's related to the same concept. And one of the things I've discovered over the years doing these kinds of deals is that you need to be on the lookout for veto power in a deal that's kind of hidden, that's not transparent or not clear or not obvious. Is there somebody that for some reason has the power to veto this deal, at the tail end that you aren't aware of as you work through the process? And this dynamic of teams of husband and wife is something I've come across multiple times. The most memorable one is one deal that we not only had an accepted offer and a signed letter of intent, but the financing had been arranged. We had a term sheet and everything was ready to go. But then the dynamic of the 4 owners came into play. And it turned out that one of the husbands was active in the business and in fact ran it, the other one wasn't. And they were the ones we were doing all the talking with. But what wasn't obvious until the very end is that the 2 wives were actually sisters and had actually inherited the business from a grandfather. Right. Why it took us so long to figure that out, I'm not sure. But at the end of the day, the sisters got along fine. The husbands didn't. And one of them was active, one of them wasn't. And even though the 2 sisters, got along fine, were no problem, and in fact, were both, just fine with the offer that had been put forward, because of the tension between the husbands, right? They didn't want to actually force the issue because it was going to bring up a lot of unpleasant stuff that they didn't want to face. And so all of that effort really went to naught because we were vetoed at the 11th hours by the sisters, who weren't really de jure. They weren't the legal controlling entities. They only had 25% like everybody else, but it was their grandfather that started the company. So that's one thing you want to be aware of. And well, that's where have your radar up on those ones. I don't know if you remember that deal or not, Carl.
Yeah, I remember that. Yeah. How old are the sellers? How old are they, John?
The age was not given on these 4, but they are at retirement age.
And that's where from the beginning, right? They're distressed sellers, but distressed sellers always has an asterisk when you're dealing with 4 people. There's the possibility, depending on how you set up the deal and what the relationships are between the 2 couples, this deal might set up well for a reverse merger where you effectively kind of move into the company and then take it over that way. That's oftentimes something you can use where sellers aren't necessarily on the same page, and you can kind of slide in sideways and do that. So real quick, before we get to the numbers, because I know we're excited to do that, we've got a couple questions in the chat I want to make sure we get answered here that tie to this. So Scott's asked, where do we get the simple model, the spreadsheet we're using? Lisa's been kind enough to answer that in the training resources. So for anyone listening, you can get the simple model as part of the Dealmaker CEO training course. It's something that comes along in there. It's given away. It's really the most valuable tool you could possibly have and value in a company pretty simply and easily. It's something Carl and I and John use in Prox, which is our private equity group in which we invest in companies. This is the base that we use for analyzing pretty much every deal and how we structure to help determine structuring offers, etc. Let's see here. Geraldo said, if they're getting 75% success rate on the RFPs, they should be growing a lot more. I think this goes back to what Carl and I were talking about, where there's growth opportunity here, because if you're getting 75% success rate, you're probably not pitching as much business as you should be. You should be out there and pushing a lot more. Let's see. Doug has asked how many employees they have. John, do you know the answer to that?
No, that was not disclosed, no. Okay,
great. And then last up, Lisa said, John, can you move the little face window somewhere else so she can see the numbers? If you mind just popping it right in the middle of the screen so people can see the full simple model.
I'm going to guess at the employee numbers, because a very good friend of mine, Daniel, owns a similar business to this in the UK. It's a bit smaller, but he's generating around $100,000 per employee. So he's doing about £80,000 per employee. He's got 10 employees and he's doing about £800,000 a year in revenues. So I would guess that they're at around 30 employees.
I would like to address the growth question. It was a great question, but here's what you need to keep in mind when you're looking at these deals. As soon as you see something over here that says all four of them want to retire, you can almost be guaranteed that these people are not on a growth orientation. Their business is not growing every year because it can't. It's not growing each year because they don't want it to. They don't pursue new business, right? The stresses associated with scaling up the business is not something that they're interested in. They're generating 600K of EBITDA every year, and they've just basically got an autopilot a lot of times when you're looking at people at that stage of life, facing retirement. So it's not so much that they couldn't grow, maybe just not interested in growing.
And there's nothing wrong with that, is there? They're pocketing $600,000 a year in cash flow. So that's $300,000 per year each for those families. So as the two separate families, that they've both made around $1 million in cash flow in the last 3 years. So that's not bad. There's nothing wrong with that. And for some businesses, for some business owners, that's enough money for them to do what they want to do. I've got no idea where the business is, but parts of southern United States, Southeast, it's not like New York or California.
Cost of living is really low.
So if you're making $300,000 per year every year as a family, you can live pretty well for that. So
isn't that where sorry, Adam, but isn't that where a lot of the opportunity lies? Because number one, they aren't set up for growth because it's not something they want to take on, and they're not even really set up for business improvement, which is saying, hey, listen, how can we sharpen the pencil really and sort of try and maximize the operational capabilities of this company? They're just not in that stage of life, when they're anticipating retirement. Maybe they're in their 60s, maybe a little older, maybe a little younger. So that's opportunity for people who are acquiring it, because there should be some low-hanging fruit associated with it on both growth and business improvement.
Yeah, absolutely. I think this is right for a sales team. Anyone with any kind of marketing chops to plug into this.
Oh yeah.
I mean, it says right in your bullet point, maybe 10 down, their trade area is the US and Canada. So they're covering pretty much all of North America. I mean, the amount of lookalike type businesses in that space where they could really be plugging in. I think the growth is tremendous. And John touched on something that was really important. People who are looking to retire don't necessarily hustle and grind in the same way many of you might want to hustle and grind. And many of you are looking to not only acquire business, to help it grow. And so it's really important to remember that mindsets are different. but that presents the value add and kind of opportunity build you'll see, right? I think about real estate as a common analogy, right? If you're going to go buy a multifamily property, say it's a 12 unit or an 18 unit or a 32 unit multifamily property, you're going to not only look at the existing rent rolls, you're going to see if they've actually renovated recently or done anything like that. Older sellers, typically who have owned it for a little while, property's outdated, the kitchens and bathrooms need updating. And if you go in there, you can add that value and increase the rent rolls. It's the same thing with a business, right? They've not necessarily had the desire or initiative to reinvest some of the cash flow into growing a sales team, to growing a marketing department, to expanding their manufacturing capabilities, to broaden their distribution and reach. So there's just a ton of opportunities in this small business space that, again, we don't have to compete with large private equities. They're not looking at this company because it doesn't move their needle. And there's not too many other competitors out there that are going to jump in and try to buy this. So this is the beauty of the small market space. There's 2.5 million companies that are just like this for sale out there. And you've got to be able to jump in and seize that opportunity. And we haven't even talked numbers yet, really. I mean, this is a company that has so much opportunity.
Yeah, and I always go back to seller psychology. So I'm looking at this and, I've reviewed the numbers in my head in like 30 seconds. So for me, it's all about the psychology. So I'm trying to imagine those 4 owners. So I'm thinking about them. So they're in their 60s. They probably have great houses in the southeast of the US. Their house loans have been paid off. They own their cars. Their kids have gone through college. They've got no real kind of expenses going out of their life. And both of those families, they're making $300,000 a year. Life is great for these people. They can do whatever they want.
Better than a kick in the teeth.
Why would they hustle and grind and push and scale? Obviously, that's our mindset. But 95% of the small business owners that you see, 10,000 baby boomers every single day are retiring in the United States, and 19% of them own a small business. So you've got 1,900 businesses coming to market every single day. 95% of those owners are going to be like these 2 couples. They're not going to be hustling and grinding and taking risks and working 50, 60, 70 hours a week. And that, as we've all agreed, I think is the massive opportunity, because there's no real barriers to entry in this market. You could argue that architectural steelwork it's a commodity, really, and they're differentiating and positioning themselves around, being quick to market, highly skilled team, great customer service. Yeah, everyone's gonna kind of say that. So I also think as well, Adam and John, I think there's a good roll-up opportunity in here, because I bet, I know nothing about their customer base or anything like that, but I bet where they're saying US and Canada's their market, I bet 80% of their, wherever this business is, I bet 80% of their market is within 100 miles of their location. So
agreed.
So there's going to be tons and tons of these businesses, maybe a little bit smaller, dotted all across the United States. And you said it, Adam, no one's going to buy them. It's trade buyers aren't going to buy them. PE's not going to buy them. It's people like us that are going to buy these businesses. So I think there's a great roll-up opportunity here where you could buy a bunch of these and integrate them all and have a national spoken hub, manufacturing, sales, and distribution model, and become quite a dominant player in this industry. Because I bet you there's businesses in this space that are doing $100 million, and they're not going to buy a $3 million business. They'll buy a $20 million business. So there's a job for somebody to hoover all these businesses up, integrate them all, and then flip them for a massive multiple to a large trade buyer or a large PE, somewhere down the line. So that's the thing that really excites me about this deal.
And I think the best part about that, Carl, is at the same time you're doing the roll up, you've got a massive opportunity to just expand organically. They're just not taking enough shots on goal.
I know.
They clearly don't have the marketing in process to really expand things outside of keeping the lights on. Again, these are couples that are making $300,000 a year, likely in a place where the cost of living isn't New York City prices. And even in New York, if you're making 300 grand a year, you're still doing pretty well. So I think it's a really cool opportunity. John, walk us through the numbers so we can dive into that. I know Carl and I have both looked at them while we're on the screen here. And let me be clear. Carl and I have not seen this prior to now. I mean, we're doing this on the fly. And I don't say that just to say it. We've literally not seen this. But what I've been able to scan, and I know what Carl's been able to scan, this is looking like something I'm excited for, and I see opportunity here for.
Yep.
Okay, let me just briefly walk you through this. A simple model is something Carl developed a number of years ago. It's a really fantastic tool. We do stress the idea of simple because we're trying to get the base case. And of course, there's always exceptions, and there's always specifics about a deal that are going to cause us to perhaps deviate slightly from the simple model, but it's a absolutely great starting point. And it really is doing two things. Number one, we're going down here, we're taking a look at what the sales, the gross profit, we take a look at the operating income, and to get EBITDA, we have to add interest, taxes, and depreciation. No interest and taxes deducted from that number, so there are no add backs there, but there was some depreciation, which was added back to get EBITDA. Now, EBITDA is not the number we value on adjusted EBITDA, which really says very often private companies will run expenses through their company that are personal to them that a new owner of the company wouldn't have to incur. And so very often, they'll get added back to have an adjusted EBITDA number. Now, this is where the red numbers come into play, because if it's red, it's an add back that we're not necessarily going to accept. Carl and I know are like-minded on this. I'm sure Adam the same way. We don't add back bad debts. I have no idea why people think that should be an add back, but very many times it is included on an add backs. They said, well, we couldn't collect that on that money, so we're going to add it back to our EBITDA. Well, no, I mean, anybody can sell their services, and have fantastic growth if they're not going to worry about people actually paying for it. So we don't add back bad debts. The owner's vehicle expense, yeah, there was no real details given on that, so I actually read that out as well. The bonus comp, is something that could be verified, so I did accept that. But that, at the end of the day, leads us to two adjusted EBITDA numbers, the one they calculate and the one that we calculate. Ours is a little bit lower because we didn't accept the owner vehicle expense and we didn't accept the bad debt in 2018. And so once we got an adjusted EBITDA number, we take it up here and we put it into this line and we come up with a multiple that we apply to it, a 3x multiple to come up with the enterprise value. Sometimes we'll use their numbers in this line. Sometimes we'll use ours, depending upon, different factors. And then once we apply the 3x, and I don't know if Carl wants to talk about the 3x and kind of the research and the framework that we have in terms of why 3x makes sense as a starting point in the valuation. Yeah. Do you want to maybe jump in on that, Carl?
Yeah, very quickly. What I would say is what's way, way, way more important than the multiple and the valuation is how you structure the deal. Adam, would you pay 5 times multiple for a business?
Of course I would, if I could pay for it every 10 years.
There you go. Absolutely. So when it comes to multiples, the vast majority of the businesses that we look at and that you will look at, they're valued as a multiple of the average adjusted profit, their average adjusted EBITDA. And the average for small businesses in the United States is between 2.5. It was down about 1.94 in 2019. It's kind of creeped up a little bit. But most businesses that sell, their profitability is kind of sub $250,000 a year. So when you go above $500,000, between $500,000 and $1 million, generally a 3 times multiple is a fair kind of estimate. But there are a lot of things that drive the multiple. Growth is one. If this business was growing at 50% per year, that would increase the multiple. If this business had IP or massive barriers to entry or was doing something highly, highly unique, that would drive the multiple as well. But with this business, it's fairly commoditized. It's pretty flat growth. It's your kind of traditional, kind of Midwest, Southeast, US company. I think a 3x multiple is about right. You could probably get away with something a little bit lower, maybe 2.5 times But I think 3x is a reasonably good stab at this stage.
Okay, and then once we've got the valuation sort of, basic framework, we're also looking at how much can we come up with for a closing payment. And typically we're taking a look at a closing payment that's going to be, driven by 5 different factors. One of them is cash. Many companies have a buildup of cash, and they have cash balances that exceed the operating requirements of the business. We typically take the operating requirements to be 1 month of revenue. So if you took, 3.3 million for 2019 divided by 12, that would be our rough approximation of how much cash was required to trade the business. If there's going to be a surplus, that surplus is going to be available, right, to form part of the closing payment. Notice that it's also added to the value of the company as well, because certainly if there's excess cash on the balance sheet, we'd be foolish to expect the owners to just hand that over. It has to be paid for, but it does allow us to form part of the closing payment.
And the reason that sellers keep cash in their business rather than taking it out as they own it is because it's more tax advantageous to sell a business. You pay less tax than if you take money out of your business through distributions. So that's why in a lot of businesses, it's more prevalent in the UK than it is in the US, but you still see it in the US. Business owners stockpile cash because they know when they sell, and they do it typically before they sell, they're going to pay a lower tax rate to take that money out and put it into
so in the US you'll only really see that with C corporations. This is an S corp if I remember from the notes correctly. Distributions to cash are non-taxable. However, people will hold cash in the business depending on how conservative they are as operators. Like where this kind of goes along with what Carl is saying, an older operator isn't necessarily aggressive and isn't likely to cash strip a business. They're not as rash in their decision making. John, if you could scroll down just a little bit to the balance sheet, sorry. It looks like they've got positive owner's equity, so retained earnings is going to be positive. So they likely have plenty of basis to take that distribution. So in reality, there's no reason why they haven't taken the cash out besides just being good business operators. This is a well-capitalized business. This is likely how I would have a business in terms of how well capitalized it is. They can ride good months and bad months with no issues, given their cash positions. Nearly 2 months worth of operating expenses.
And that's a really great point, Adam. When we look at deals, we look at how healthy they are right now, because obviously if the business wasn't capitalized well and it had tons and tons of existing debt already inside of it, then it possibly can't work as a leverage buyout, because as an LBO, when you put more debt onto the balance sheet, then sometimes that can really choke the company in terms of your ability to want to grow it. So having a really nice, healthy balance sheet, really nice, healthy business, that's a really positive step. That ticks box number 3 in the deal-making triad, that you've got a financial DNA in this business already, which means that it's going to easily absorb an LBO deal structure.
All right, and to continue on in terms of financing the closing payment, the next thing we take a look at is what kind of borrowing could we potentially do against the asset? That's asset-backed lending. And, as Carl likes to describe it, the rocket fuel of LBOs tends to be the receivables. It's the easiest thing to finance. So we take the 741 of the accounts receivable, we pop it up here. But now the all-important question is, how much of it can we borrow? 65% is a fairly conservative loan-to-value ratio. We call that the LTV. And the reason why it's fairly modest is because we don't have any information in terms of the aging of the receivables. We don't have a breakdown in terms of what that number represents, whether it includes, things like retainage or, costs in excess of billing or other things like that. So to be conservative, without knowing that information, use a fairly low ratio. If we knew that this was not concentrated, if it was all less than 90 days, if there was no retainage, no excess costs of billing number in there, Carl, Adam, what would be a good loan to value ratio used if that was a pristine number and we could borrow, against the entire amount?
I would go up to like 85, 90% if it's super pristine.
Yep.
Yeah, there are 3 things that determine the percentage when you're financing accounts receivables. One is the concentration of customers. The fact that they've got 76 active customers means you've got a very diversified customer base. So that will tick that box. And then the way accounts receivable financing works is you're not selling the invoice. That's called factoring. What you're doing is you're offering up the invoices to a financier who loans money against that asset, which acts as security. So what an AR financier will do is it will credit check each of those customers. So if all of those customers have got good credit, then they'll apply the full amount of discount. The other factor that determines AR is how old the debts are. So if the invoices are more than 90 days, then typically you can't finance them. I just did a simple calculation. The average invoice is 81 days overdue. So, and the way you do that is it's called DSO, days of sales outstanding. You divide the 742 of receivables into the 3346 of revenue and multiply by 365, you get 81 days. So what you'll have in that receivables book is some of those invoices are likely going to be more than 90 days. 81's the average. Some of them will have been issued in the last week or last month, so they'll be current. So I think 65 for this is a really good conservative assessment. You might get a little bit more, but until you've got the full AR book and you've sent it to a financier that's done the deep dive on it, you won't get the final number.
Agreed. Next thing we take a look at, like I said, was 5 things that typically go into closing payment: surplus cash, if any, some percentage of the receivables that we might be able to finance. Inventory is possible, but can be challenging. To be able to borrow against inventory, typically there has to be a really tight inventory management system. A lot of inventory lenders want a fairly large number before they're willing to put in an inventory facility. But it is an asset. It is potentially something we can borrow against. 25%, that number is going to vary widely depending upon the kind of inventory we're talking about. You know, if we're talking about perishables, you know, obviously the number's close to 0. Other stuff that has a very known and active secondary market, the number might be a little bit higher. And I don't think we would have the time to dive into every one of those, but inventory is one possibility as well. The fixed assets, and it's the net value that we're taking a look at. The fixed assets here gets popped in here, and then we determine what the proper loan to value ratio might be to borrow against those assets. And if there's property in the deal, that's the 5th potential. And, I know Adam and Carl are, always having great debates about the value of property in terms of the attractiveness of trying to close this deal. And, we can't unpack all of that as well. But if there was property, that's where it would go. And of course, we would net out any money that was owed against that property. And that helps
on
us
the property, John. On the property, can we just talk about the property for a minute? Because there's a couple of notes in your sheet about the real estate. One is that the real estate is owned by the families independently, so it's not on the balance sheet of the business. But they're saying that we need to come out of the premises sometime in the first 2 to 3 years after sale. Do we know why that is?
I think basically they're probably going to want to sell them. And okay. I think the idea is, I think, is that it's not very efficient being in both of these premises. There is some capacity limitations as well. So I think the sort of the accepted wisdom from the seller is, listen, you wouldn't want to be in a new facility anyway. It's going to be a lot cheaper and more streamlined to be in one facility rather than 2. You need some excess capacity if you want to grow the business. And by the way, this is part of our nest egg, so we'll probably be interested in selling it over the next 2 to 3 years.
Well, that's good. Sounds like there might be some cost synergies when that combination happens.
I think so.
Increase the margins of this business.
Just speaking for 2 different things real quick. One, I think they've made a critical error as sellers in telling us they think another space is more optimal when they themselves own the real estate. You're effectively killing your own value of the real estate by saying, hey, you're going to need to leave to grow this thing. Right. So that's probably, I would say it's less than optimal positioning on their part. But 2, it does tell you a little bit about the psychology of the sellers, which is that they are very much partners holistically. They've both acquired commercial real estate and they've operated the business out of 2 locations. And so not only have they been pocketing, as we talked about, that $300 or so K a year per family, they've been stacking rents in on top of it. And that's, so they're doing very, very well off of this. For me, yeah, Carl and I talk about property all the time. We've got slightly different positions. In this particular case, I would probably be looking at evaluating the synergies and opportunity to relocate as part of the transaction. I would be looking at what the existing leases are and try to get out of them as part of the transaction. If it looks like it might hurt my chance to buy the company, I'll just sign those short-term leases and make sure I've got some good buyouts or exit options in the lease. But I'd be looking to move much faster than the 2 to 3 years.
Yeah. One question on the leases, as part of due diligence. In fact, I'd want to know the answer to this before I even made an offer. I'd want to know what the lease costs currently are, whether they're being done at market rate, whether they're overpaying to put more money into they probably bought their property through their 401k or something like that. So they might be overpaying for the rent, they might be underpaying. We don't know. I want to see.
I didn't put it in the notes, Carl, but it was addressed in the IM that they felt that the company was paying market rents and there was no adjustment necessary. That's not a bad thing to double check and confirm for ourselves.
Yeah, it's always something to confirm. And I think just to address this point, John talked about add backs down lower in the simple model. Oftentimes you will see brokers and other intermediaries adding rent back, especially if it's a related party. So say the owner owns the real estate and then the business operates and pays rent to the owner. They'll try to add that back and say, oh, it's seller's discretionary income or something like that. And it's not. It is not, because no matter whether you own the real estate or someone else owns the real estate, you always will have to pay for occupancy. That's a real cost of the business and should never be added back. So just for anyone who's doing deals, just keep that in mind. That's a massive do not add back. The only adjustment you can make to rent is to either increase it or decrease it to fair market value. Other than that, you can't add it back fully. So quick aside there. John, so I think we've worked through most of the balance sheet in terms of how we can finance it. Last one there is surplus cash.
Yeah, I mean, there is definitely surplus cash. 409,000. Where did that number come from? We took the 688 on the balance sheet. We subtracted 1/12 of that number, and that was the surplus cash that we came up with that we could potentially include in the closing payment. Of course, we have to add it to the value of the business. And let me just make a little note here, Adam, of the valuation. We come up with the 3x multiple to come up with the enterprise value of the company, right? And the enterprise value of the company is going to have the surplus cash included. But since we're not really buying the company, we're buying the shares, we're buying the equity, we have to independently value the equity, right? Which can and often is different than the value of the enterprise. And you do that by, of course, subtracting the financial debt. There's very little of it in this company. There's just some lease obligations down here on the balance sheet. But there is a differential between enterprise value, equity value, and that difference typically tends to be.
And if you have the simple model, it does it all for you. But in simple math, enterprise value to equity value is you add things like real estate, you add things like surplus cash, and then you deduct any trading liabilities that this business has. Bank loans, overdrafts, HP, tax payments due, all those different things.
Yeah. Now, I don't know how much time we have to get into other issues.
Yeah, let's keep going. I think we're on fire. So let's keep rocking this.
Yeah. Okay. And by the way, open door to questions that you might have.
Yeah, we're gonna get to some questions in a couple minutes. Okay. And so guys, if you have questions for what you've seen, just pop them in the chat, and we'll get to them. We'll get to them very shortly.
But when we put an offer together, it's typically got 3 components. It's got a closing payment, which we get from surplus cash, receivables, inventory, fixed assets, and property. It's got a seller note, which is basically deferred payments. We're asking the seller to, to hold a note that we're going to pay over time. And then the third part is the amount of financial debt that we assume. Together, that's the total consideration that we're willing to pay for this company. Now, if there's a situation where we require equity, the simple model does have a spot for it. We certainly look at deals where we will, anticipate and look at ways that potentially equity could be used in that deal. But our base case is, Yeah, we prefer debt. It's the cheapest source of funding. And so if we can do this deal on an all debt basis, that of course is our first preference. I don't know if you want to get into SBA type deals here or not, Adam.
Yeah, yeah. I mean, we can talk SBA for a minute. I think the biggest thing with SBAs is you've got to understand two main characteristics of an SBA loan. You're going to have to put in cash or equity. I'll talk about that in a minute. And the second is personal guarantees for anyone who owns 20% or more. If you were interested in putting in cash and you did have the capacity to handle the personal guarantee, this company could actually set up well for an SBA deal.
That's what I was thinking. Yeah.
Simply for the fact that all the owners are looking to exit. SBA deals have a requirement of any owner of the business needs to be fully exited, whether in an employment or consultative manner after 12 months. And so this could set up well, since all of them are looking to move on, and there is second tier management in place who could potentially fully run this thing. Going back to the cash. So cash is always the question. Hey, Adam. Hey, Carl. Hey, John. We're doing no money down deals. We're doing deals where I don't have to put any of my own money in. It's using other people's money. Well, if the SBA is going to pay 90% of the value of this, that means I still got to come up with 10%. So there's ways to get around that. One is go find a partner. Find someone who has capital, bring them in, dilute your portion of equity. So instead of owning 100%, you'll own, say, 40% or 60% or 80% or whatever deal you need to come in for them to supply the equity financing and also support the personal guarantee. So in that particular case, you could still put in none of your own money while also saving yourself from any of the other troubles. So that's the SBA. Right now, lots of things are happening. So plenty of things going on.
So this is a nice, simple deal then, because the business is worth roughly 2.2 million. I'd probably go in at around 2 million. Half of it is looking like a closing payment. The other half is a nice seller financing note. I just want to mention something about coronavirus right now, because I know we're kind of looking at this holistically in any kind of market scenario. But there's two things I like about this as well, this deal, where it comes around to coronavirus. So number one, I think this business could massively pivot as well. And what my friend Daniel's doing, so he has an architectural steelwork company that's a lot smaller, and where he's absolutely killing it right now is he's manufacturing gym equipment, and he's offering to go around to people's houses and install it. And literally, he's making more money doing that than he was making his original staircases and balustrades and all those different things. However, that bit of his business is still growing, because what he's found is a lot of his customers, because they're on lockdown, they're using that lockdown time when there's not a lot of people in their facilities to install new staircases. And he has a retrofit business as well. So I think this is an example of a deal that not only can survive COVID-19, I think can also thrive from it.
Yeah, I completely agree. And I think the diversity of clients is a huge value here. And because they're clearly not marketing, it just means when things are bad, increase your advertising. We were just on a mastermind this morning, and Carl and I will be for the rest of today and tomorrow. Shout out Todd Brown. And one of the things we were talking about on that call this morning was how important it is when things are going poorly to be increasing your advertising spend and increasing your marketing, because those are the businesses that'll come out of any kind of hiccup or disaster fairly strongly. So before we get to how we would potentially structure this deal and things like that, let's just answer a couple of questions that we've got going on. Let's see here. Guys, do you think you'll still be able to get the kind of financing against invoices in this current climate? I think Carl kind of answered that to some degree, and that was from Nigel. Yeah, I think AR in this environment, no issue, especially if you're discounting. If you've got good client list, diversity of clients, and the outstanding, the current nature of that debt's going to be pretty favorable. How are buyers how are buyers meeting employees to assess team and culture before making offers given stay-at-home and social distancing? I think it depends on the business. We're doing a call via Zoom right now. There's plenty of ways we're communicating with our own teams and things like that remotely. But I think people who are good team members and A players and strong members of a company will come through and shine pretty well. So that's Linda. Ali asked 3 questions, but we'll just answer, let's see here, the third one. Financing in post-pandemic times, banks will be very cautious to finance an LBO. I believe the acquisition model should change. Do you agree?
I don't agree. No, I don't agree with that. What I do think will happen, I disagree with that completely. What I would say, where I think he's going with his question, which is true, is that I think you're going to see a lot more businesses come to market over the next 6 to 12 months. I think a lot of people will use coronavirus just as kind of the straw that broke the camel's back. They survived 9/11, the global financial crisis, other struggles and recessions, and now this. So I think a lot of business owners that were maybe going to retire 2 to 5 years from now will think, you know what, it's time. This is a sign. Let's do it. And I think when you get a lot more businesses coming to market, it just changes the supply-demand economics. There's 2.6 million businesses for sale right now in US, Canada, and UK, and that could easily double over the next 12 months. So, we've still got the same number of buyers. We just got a lot more sellers. So I think the model could change where a lot more of these deals can go into seller financing. Because if you've got a seller that's highly motivated to leave and they don't want to go into the business anymore, just taking all of their payments over time and having the right security over the business to make sure that you pay them, I think there's going to be a lot more of that. Personally, on this business, because I think the balance sheet is so good and so strong and there's so much growth opportunity, I think it'll be a cakewalk to get some financing into this business. You might not need to pay $900 or $1 million at closing. You might get away with less than that in this current environment. But I think this deal is very easily fundable.
Yeah, and because these 2 families launched the business back in 2002, they've probably got a lot of emotional connection. Because remember, it's not just a husband working in a business and he's owned it. This is 4 people who have been integrated from the beginning. It looks like, so they're very emotionally involved. And so what I would say is you can leverage that a little bit in your deal making and trying to find an opportunity that pays them well. So again, like Carl said, I completely disagree that LBOs are going to be negatively impacted by and large. It's one of the most common forms of acquisition, period. It's pretty much what every private equity does. Even when they're putting cash injections in, they're using their investors' money, not their own money. So I think LBOs are going to continue and thrive. Chrome Clapper, what a great name. I'm assuming the RFP success rate can be fact-checked during due diligence. Yep, yeah. That's straightforward and easy. Those are all.
You know what I think about that? Do you know what I think about the RFP?
Yeah.
And again, this is another opportunity for me. I think the fact it's so high, let's assume it's right. I think the fact it's so high is they're only bidding on jobs they want. I think these guys probably turn away a lot of business. You can tell. I think they're just happy in the 3 to 3.5 million revenue range. They don't want to build a $5, $10, $20 million business. I think a lot of the stuff that they see, they think, nah, don't want to do that. That's clearly not going to be the case if we own the business. We'll be bidding on everything.
Yeah.
So I think that they're better 5xing their bids and getting a 50% hit rate.
Yeah, so I completely agree. I think it simply tells me if we use a basketball analogy, right? they're Shaquille O'Neal taking shots and slam dunks and layups, right? They're not firing up 3-pointers like Steph Curry, which is a guy on your team there, Carl. Let's see a couple more questions here. we already answered the financiers loaning against invoices. We've got a couple people asking about real estate. We'll get to that in 1 second. Are they currently doing a lease back to their business? Yes, they are, since they both own the property in their own names. Why wouldn't they want to keep collecting rent? I think they do want to, but I think they recognize the business could use some optimization instead of working out of 2 locations. I think that's what John said. David McLaughlin asked, do you offer interest on the seller financing? It depends. We'll generally, with deals that we're doing, we'll generally go in and say no. We'll generally go in with an offer that doesn't include interest. And if they come back and say, hey, we'd like interest, we'll do some kind of market rate that's generally in the 4 to 6% range.
Yeah, and if you make an offer, the seller comes back and asks you, can you pay interest on the seller financing? You're very close to a deal. If they're not balking at the valuation or the deal structure or the amount of seller financing the deal, if their only pushback is, yeah, can I have 5% interest on my seller financing? In this deal, you would do it because it's got so much cash flow. That's a great signal that your seller is really, really close. And then you just need to tweak the deal a little bit.
It's a great thing to keep in your back pocket when you're putting a deal together, because it feels like a big win to the seller if you're adding interest on any seller financing. Let's see.
Should we vote? Should we vote?
Yes. Before we vote, one last thing I want to make sure we highlight here is down at the bottom of the simple model, you guys will see a green box that says 1.8, and that's the payment cover. So when Carl and I have been talking around, hey, this thing's got plenty of cash, it can pay the debt very well. This is quite literally saying, what is the debt obligation versus the free cash flow or earnings of the business? Banks, for example, banks have a threshold of 1.25. Our minimum's 1.5. So we're more conservative than a bank. In this particular case, using the numbers John has in here, where they would get roughly $900,000 at closing, which would include some level of asset financing plus surplus cash, with the remaining 1.3 in deferred, we've got a payment cover of 1.8. And I have a feeling that we could structure this deal in a way where that number would go up, right? Under an SBA loan, I think that number could go up because SBA loans are over a 10-year period of time. And you could actually give the sellers more money up front by doing an SBA if you could find a partner or someone to put the equity in for.
And if you did that, I think you could get the business for less money. If you're paying a lot more money at closing, you can buy the business for an overall cheaper number.
Yeah, I agree. I think if you walked up to these people and possibly gave them a $1.5 million acquisition and they're getting 90% of it up front, plus they get to keep their surplus cash, I think they do that. So John, you want to explain the red light, green light, and Carl and I will pop in there?
Yeah, for sure. Before that, let me just sort of throw my closing comment on here. And that is the whole dynamic between buyers and sellers. I mean, it's a supply and demand type issue. The supply has been building steadily over the last 3 or 4 years. We're on the brink of the largest intergenerational transfer of wealth in human history as the baby boomers hit retirement. And so there's pent up supply in terms of people looking for an exit. 6 months ago, a lot of times people felt like they could dictate terms in terms of how they exited. I think that's changed now. And so what I find and what I see every day is sellers looking for quality buyers. And quality buyers are people who, they trust and respect, who are a safe pair of hands, who have the operational chops and the history to be able to stick handle, through this sort of difficulty, right? And have the integrity to make good on a seller note over time. And so, yeah, it's a difficult marketplace, but don't underestimate the value of a quality buyer in the eyes of so many of these sellers, right? Where we had this pent up demand, that's really coming to sort of a peak right now. And let's face it, it's hard luck if you're a seller. We could tell you all kinds of horror stories of sellers who turn down very good deals, who are really not in an ideal position right now. So I would encourage everybody out there to recognize the value you would have as a quality buyer to sellers, right? Who were planning to exit anyway, right? And I think this is just kind of going to accelerate that. Having said that, let's go to red light, green light. I mean, typically when we started doing these, it was a thumbs up, a green light. If we thought this was a viable deal, that we would be interested in submitting an offer. Red light if we didn't. But just to make it more fun, I decided to put a number to it as well. And that number will tell you how strong of an opportunity you think it is. So if it's a green light, you're going to have a positive number. If it's a red light, it's going to be negative. And all we do with the number is just say, how good is the upside on this deal on 1 to 100? And let's subtract out how much downside there is in there. So we actually had a deal yesterday that had a green light 100 score by more than one person on this call, because we just thought the upside in comparison to the downside was absolutely, unbelievable in that deal. So that was a green light, and we gave them a number of 100. So that's what you're doing. You're taking a look at the upside out of a score out of 100. Let's say you thought it was 60. Then you took the downside. You thought out of a score of 0 to 100 it was about 30. Take the 60, subtract the 30, you'd have a green light for 30. If you don't like the deal at all, you're going to have a red light and you're going to have a negative number. Hopefully that made sense. So what I want you to do is go to the chat, take a look at the entire deal, the intangibles, the notes, the tangibles, the numbers, right? All the stuff that we've discussed. First thing you have to decide, green light, yes, let's submit an offer on this deal, or red light, you know what, I'm going to pass. I'm going to move on to another opportunity. And then if it's a green light, I want you to tell me how strong you think the opportunity is by taking the upside and subtracting the downside. Hopefully that made sense. I'm getting ready to vote.
Yeah. Are we voting verbally or voting in the chat?
I'll log yours in the chat, guys.
Okay. So I'm 80 on the upside. I think there's so much opportunity to scale this business like crazy and to pivot in the current environment. So I'm a plus 80. I'm negative 20 on the downside, only because I think there's a lot of work to be done on the seller psychology of the different shareholders and how the shareholders agreement ties together. So I'm going to be plus 60, and it's a big green light for me. I would do this deal in a heartbeat.
Yeah, so I'm almost the exact same numbers. I think there's a lot of upside here from the sales and marketing side. I think the balance sheet on this thing is very strong. I think it shows good conservative management. The business is very well capitalized. I think my upside is probably the same, about 80. In terms of downside here, I think we're going to have a little bit of risk as we look to find those synergies, relocate the business into one shop. We're going to incur some costs associated with that in the short term. I think the business is well capitalized enough to handle that kind of transition, especially if you're expanding. So for me, I'm saying upside of 80, but I'm going to say downside of 30 just because of the added risk that comes in. So for me, this is a green light at 50.
My own view on this, having prepared this deal, is I do like the business. I wouldn't put it as high as 70, but I would be probably in around 65 or so. I see a little more risk in this deal than maybe Carl and Adam do. Not just the move, but I really don't like the dynamic of the two husband and wives. I mean, there's just so much that goes on there. Maybe I'm traumatized by previous deals. I don't know. But I'm 65 on the upside, 40 on the downside. So I'm giving this a green light and a 25.
So John is a green light at 25. Well, great. So let's see here. We've got Lewis who's saying green go. Nigel saying thanks for the analysis. Gerald asked why only 25,000 in fees on the simple model. We're saying that's 25,000 for our own attorney costs and an accounting costs for due diligence. If we're to do this deal, we do some of that in-house through Prox, our private equity group. Carl and I have. And so, we're really only paying legal fees. Someone asked, well, does that include, finance brokers and things like that? Generally, finance brokers, those costs get rolled into the loan. You're not necessarily coming for that stuff with cash, depending how you do it. Yeah, say you're financing 500 grand. If you've got 50K of cost, they're handing you a check for 450,000. Let's see what else. Chrome's giving us a green light. Nate's going to go home and focus on the replay of this call. Great, Nate. Happy for it. Mike has given a green light of 45. WorkPoint Recruitment, green light of 50. So we're getting some green lights here, you guys. I'm very excited about that. Let's see. Robert's a green light of plus 65. Which is
wow.
Great. So got some really favorable folks here. Lisa's a green light of 20. Mark's a green light. Nice work, guys. And we have to say, like, opportunities like this exist all over, and you've just got to get out there and originate. Let's see. Usman asked, how much does it cost to join the deal review program? Well, this is part of our Dealmaker Academy. If you go to Dealmaker Wealth Society, you can find an opportunity to get involved. This is weekly calls. John leads those. Carl and I are there along with our other coach. These are every Thursday at 11. For those who subscribe, we've got an exclusive Facebook group for people who are Dealmaker Academy. So head to our website and you can find opportunities to do that. If you guys are interested in learning about how to do deals and what the 10-step process is that Carl teaches, we'll drop a link in the comments here for Carl Allen's Business Plan Blueprint. Just a good opportunity, no cost to that, to get an idea of how we do the framework of deals. Let's see, we got a few more green lights coming in. Dolly is a green light 40. Doug is a green light 30. Gerald's a green light 60. And we got another great compliment. Great job, Dealmaker team. This is great. We care for our subscribers. We do, guys. We want you guys to really be successful. And to do us a favor, feel free to hit like on this, share the video. We love the interactivity. Carl and I are live on Fridays on Facebook. If you don't like Dealmaker Wealth Society on Facebook, head over there, click like on that, and you'll see us on Mondays at 11 a.m. Eastern, 4 p.m. GMT. And then on Fridays, we're here on YouTube doing live calls. You know, hats off, John. Really, thanks for joining. And yeah, so if we get any more,
one thing we do on the red light, green light that Adam hasn't mentioned yet is we sometimes toss the spotlight on people who are part of the academy who have actually closed deals. We have one team who actually met in the academy. They've teamed up, they partnered up, closed 2 deals, very close to closing their 3rd deal. And so every once in a while, we'll throw our spotlight on our academy members who are making it happen, learning and making it happen and closing deals in the field.
Yeah, absolutely.
That's a fun part too.
Yeah, John, if you want to stop screen share and we'll just chat here for the last few minutes and answer any other questions people have. We're really glad you guys could join for this. We've not done any live deal review. So if you guys have more questions, we'll get into it. I set aside the one question that was asked by a couple people about how do you handle a company that has real estate that's owned free and clear? Would that be considered an asset, and how difficult would the deal be able to do? So Carl, I'll throw this to you first, just because I know you and I have different opinions on real estate and how it works in a deal. But I figured it'd be a good one to start with you.
Yeah,
again, this is a company that owns real estate in the business, free and clear.
Yeah, so personally, I do more deals without the real estate than with them. I know, Adam, you're more of a real estate nut than I am. I know you own real estate all over the world. You know, I don't. I'd rather just buy the business and focus on the business. Where I'll buy the real estate is when the seller's mandating that it's part of the deal, and I can get a better deal on the business by buying the real estate. Obviously, real estate, it's one of the most fundable assets that a business can own. And even if I don't want it, there's opportunities to sell that real estate to a property investor and then tag along with it a nice big kind of rental agreement, so that the real estate investor's getting the nice yield on buying that real estate in a back-to-back transaction. So there have been deals where I bought real estate, but it's only when it's helped me skew the deal, because you can get more cash down as a closing payment as an overall amount, and where the seller really wanted to get rid of it, and it meant I could buy the business for a lower amount.
Yeah, exactly. In the case a business owns it straight up, you've got a couple options. You could go in and you could refinance the property and you could bring cash forward. In that particular case, because everything's commingled so tightly, there's no rents being passed on or anything like that. I would actually, in that particular case, I would go out to a real estate investor and I'd say, listen, market cap rates, which is simply the rental rate divided by the value of the property. I would say, listen, I'm going to give you a favorable cap rate. And for me, knowing the cash flow of the business, I'm going to increase the rent to probably a little bit above market value to drive up the value of the property. So when I'm going to the seller of the business, I'm saying, listen, the property's worth 800 grand. You know, the business is worth $1 million. So combined, it's 1.8. I'm going to give you $1 million at close, because then I'm going to a real estate investor and I'm jumping my rents up a little bit. So I might spend an extra 10, maybe 10,000 a year in rent, which is not significant in terms of my cash flow. That drives the value of the property up. They spend $1 million for the property. Seller's got $1 million closing payment, and I'm now getting a business for 800 grand instead of $1 million. So there's ways you can play with it. For me, I do like real estate. I do like owning it and investing in it. But in that situation, you can really play with the value when it's all in one company.
Yeah, I'll throw 2 cents in here if you don't mind as well.
Yeah, absolutely, John.
There's a huge difference in my mind between whether the company owns the property or whether they don't. Because if it's a related entity you have to acquire, you have to pay full price. You can get financing on 75% of it, but then you've got to finance the down payment in some way, shape, or form. Many mortgage lender wants you to have some skin in the game, regardless of what the dynamics look like. So it becomes more challenging on a cash flow basis and coming up with the down payment. However, if the company already owns the property free and clear, then financing it 20%, 40%, 50%, right? Not the same hurdle, not the same challenges, can be very helpful, not the same cash flow pressure. So in that case, yeah, I think it's a fantastic add-on to a deal. When it's related entities, it's a little more challenging.
Yeah, absolutely. And the key difference there is it in the core operating company, or is it sitting outside? If it's sitting outside, you have a little bit less flexibility. You very much have to go likely the investor route to get them to buy it. You set up that kind of long-term lease so they feel secure in their investment. And you've got to know that the business isn't going to have to relocate anytime soon. So that you're comfortable and confident signing that lease. Have to say, I think we've answered most of the questions, guys. If we missed any, feel free to let us know, and we'll try to take care of it. Next week, we'll have at this same time, 11 o'clock Eastern, 4 p.m. GMT. We're going to have another Q&A. We'd love to see you guys there. If you haven't done so already, subscribe to the Dealmaker Wealth Society YouTube channel. Whenever we go live, you'll get a notification so you can come join us and see what we're doing. We really appreciate it. Love to have you guys as part of really our bigger Dealmaker Wealth Society family. Carl and I believe so much in the vision and pursuit of buying businesses and acquiring and building an empire of companies, and we want that for you guys. Carl, any parting words before we get out of here today?
No, it's just always an honor and a pleasure to to coach and do these types of sessions. No matter where you are in your deal making journey, I hope you got some real value out of the session today, and look forward to seeing you guys again soon.
Yeah, absolutely.
Great weekend.
And John, couldn't thank you enough for being here and really hosting this. You are an all-star among all-stars in doing this.
Appreciate that. Let me throw one parting comment in myself, Adam. I'll keep it super short, and that is, we've had some people in the Dealmaker Academy 12 months, 14 months to see the growth that these people have from when they show up at our door to the deal maker that they've turned into, and the deals that they cut, and the things they've got going, and the money they make. It's absolutely phenomenal. So I'd invite everybody to join us. We have a blast every Thursday. It's a ton of fun, and I'm really enjoy it, and I'm really glad I got the opportunity to be here today too as well. So thank you for that.
Absolutely. So thanks, guys. We really appreciate it. If you need any more information, dealmakerwealthsociety.com, or check the link in chat to get your copy of Carl Allen's Business Buying Blueprint. We always want you guys to be thinking next level and thinking where you're going. This is a wealth creation journey where we're not talking about little money. You can create generational wealth here, and that's what's exciting. So thank you guys so much. Remember, you're only one deal away from changing your life, and it's really critical that you take action to get there.
Have a great weekend, guys. We'll see you soon. Until
Take
then.
care. Thanks. Bye-bye.